You know, for your entire career, you're told to save, save, save for retirement. But what if I told you that how you save is just as important as how much you save? Today, we're going to talk about building a retirement that's truly tax efficient. Because let's be honest, it's not just about the money you make, it's about the money you actually get to keep. All right, let's get into it.
So let's just start with the biggest question of all. After all those decades of hard work and careful saving, how much of that nest egg is really going to end up in your pocket to spend? Well, the answer comes down to one thing that a lot of people just don't think about until it's way too late.
And that one thing is taxes. Believe it or not, for many retirees, taxes can become their single biggest expense. It can take a huge bite out of their income right when they need that money the most. So many of us are focused on growing our assets, but we totally forget to plan for the tax hit on the other side.
And that's exactly what we're going to unpack today, that hidden tax drain. Because a really smart plan isn't just about saving more money. It's about saving it smarter, with a serious focus on tax efficiency.
A huge part of the problem comes from just relying on one way of saving. Putting all your eggs in a single basket, even if it's a great basket, can create a massive, unexpected tax headache when you finally go to take that money out.
So, what's the solution? Well, it's actually surprisingly simple. The best way to think about this is with a really powerful mental model I like to call the 3 tax buckets. This is the key to getting it all organized.
That's right. When you boil it all down, the entire complex world of retirement tax strategy really just comes down to 3 simple categories, or as we're calling them, buckets. Once you get this concept, everything else just starts to click. And here they are. The 3 buckets are taxable, tax-deferred, and tax-free. Now, each one has its own set of rules for how and when your money gets taxed. And understanding those differences, well, that's where the real power is.
Okay, so let's pop the hood and take a closer look inside each of these buckets. We're going to see how they work, what kinds of accounts they hold, and why you'd use each one as part of a bigger, smarter strategy. First up, we've got the taxable bucket. The easiest way to think about this one is as your pay-as-you-go bucket. With these accounts, you're usually paying taxes on any growth like dividends or interest in the year you get it. There's no special tax break here. So what kinds of accounts are we talking about? Well, these are your standard brokerage accounts, a lot of investment portfolios, and things like high-yield savings accounts. They give you a lot of flexibility, but they're not tax-sheltered. Now for bucket number 2, tax-deferred. This is the one most of us know really well. The whole idea here is that you get a tax break today. Your contributions are often pre-tax, and you just delay paying those taxes until you start pulling money out in retirement.
This bucket is home to all the heavy hitters of retirement saving. You know the ones, your company 401k, traditional IRAs, and other plans like that. Essentially, you're kicking the tax can down the road.
And that brings us to our third and final bucket, tax-free. And let me tell you, this one is incredibly powerful. If you play by the rules, money in these accounts can grow and be taken out in retirement completely 100% tax-free. That means it doesn't even show up as taxable income. The classic examples you'll hear about are Roth IRAs and Roth 401ks, where you put in money after you've already paid taxes on it. Some types of cash value life insurance can also be set up to give you tax-free income down the road.
This slide right here really just boils it all down. With tax-deferred, you're just pushing that tax bill into the future. But with tax-free, assuming current laws, that tax bill on your qualified growth and withdrawals, it's gone, for good. That is a huge advantage.
Okay, so knowing about these buckets is one thing, but the real magic, the real game changer, happens when you start using them together. And this brings us to the power of tax diversification.
So here's the crucial point. If all of your retirement money is sitting in that tax-deferred bucket, like in a 401k, then every single dollar you withdraw is taxable income. A big withdrawal in 1 year could easily push you into a higher tax bracket than you were ever in while you were working.
And this shows you exactly what that tax bite looks like in reality. You might plan to pull out, say, $50,000 for the year. But after federal and maybe state taxes take their cut, the amount you actually have left to spend can be a whole lot lower.
The solution to this is tax diversification. It's the same idea as not putting all your money into a single stock. By spreading your savings across the taxable, tax-deferred, and tax-free buckets, you give yourself options, flexibility, and most important of all, control.
So, how do we actually put this all together into a smarter retirement strategy? Let's take a look at what a really practical plan for your retirement income might look like.
A really strategic plan breaks down into 4 key actions. First, you're actively balancing your money across those 3 buckets. Second, you strategically manage your withdrawals each year. Maybe you pull from a Roth account if it's a high-income year to keep your tax bill down. Third, you plan for the very real possibility that tax rates could go up in the future. And fourth, you make sure all of this lines up with what you actually want to do with your life.
When it's all said and done, it comes down to this powerful idea. The thoughtful planning you do today gives you an incredible amount of control over your financial life later on. You get to be the one to decide which tax lever to pull each year in retirement.
So, I'll just leave you with this one final thought. Take a minute and think about your own savings. Is everything piled into just one bucket, or have you started to diversify? Are your retirement buckets really, truly set up to give you the future that you want?